So, welcome to today's presentation. My name is Peter Youssef, Senior Market Analyst at IronFX. We're going to be mixing technicals with fundamentals today. Please note that we have Euro USD's daily chart in front of your screens right now. Let me make small readjustment here. Now, we have some conflicting messages. On the one hand, the pair was unable to breach the S1 1.0730. So that tends to imply some sort of stabilization. On the flip side, though, we have to note that the bearish tendencies were renewed today, and the RSI indicator has dipped below the reading of 50, implying more or less aiming for the reading of 30, which tends to imply that the bearish sentiment is building up for the common currency. On a fundamental level, the uncertainty caused by the European elections practically over the weekend tend to continue to weigh on the common currency. May I also add here that monetary policy-wise, the ECB's rate cut tended to imply an uncertain but still present tendency or predisposition for more rate cuts to come. So that could weigh on the common currency as well. While financial data tend to remain rather lukewarm, so we're getting some conflicting messages there. Should the bears maintain control over Euro USD, we may see the price action breaking the S1 1.0730 and start aiming for the 1.0670, while even lower, we note the 1.06. That's a level where we had a total reversal of the downward direction of the pair and had a nice upward movement, which holded out for about a month or so. Now, we've covered already the euro part of the pair. Regarding the USD, okay, definitely we had a strengthening of the US dollar on Friday. You can see it right here. And that was due to the hotter than expected US employment report for May, as we have mentioned. Now, the attention is turning increasingly towards the Fed's interest rate decision tomorrow and the release of May's CPI rates of the US. Now, the first release would be the US CPI rates. Overall, there seems to be expectations for inflation to be rather sticky, which, if combined with the hotter than expected employment report, tends to provide additional support for the US dollar. Yet, I think the main factor which will be determining the direction of the US dollar is going to be the Fed's interest rate decision. The bank is widely expected to remain on hold. That's not the question. The big question, in my opinion, would be the forward guidance and the new dot plot. We may see a hawkish tilt on behalf of the Fed. And in such a case, that may contradict the market's expectations for a rate cut in November and actually provide additional support for the US dollar, which could drive Euro USD even lower. On the other hand, let's flip charts now and go to USD JPY. USD JPY is edging higher once, twice, but overall remains well within the boundaries set between the R1 157.75 and the S1 154.55. You can see the rectangle, the orange rectangle, which is exactly highlighting more or less the current course and direction of the pair in a sideways manner. Let's not forget, though, that since the start of the year, the pair has been an upward movement, an upward channel. So we're getting some conflicting messages. On the one side, we see the sideways movement of the pair since the 1st of May. On the flip side, we can see that there may be some bullish tendencies. I would note that the RSI indicator has reached above the reading of 70. It's at 57, which tends to imply the presence of some bullish tendencies on behalf of the market participants that may drive the price action of USD JPY higher. For the bulls to take over, we would require a higher peak than this one. So the price action has to breach above the 157.75 and start aiming for the 160.20, which is a record for a number of decades now. On a fundamental level, I'm quite worried in the sense that should USD/JPY continue rising, that would prompt Japan, the Japanese government, and BOJ to actually once again intervene in the markets to the JPY's rescue, which may cause an abrupt movement downwards of USD/JPY. You can see it right here. That's what happened the last market intervention, 1 day, 2 days, correction, then a continuance lower, as low as the S251.90. So we're getting some conflicting messages. For the time being, the sideways motion scenario seems to prevail. For a bullish outlook, we would require a higher peak than the R1. And once again, on a fundamental level, we're issuing a warning about a possible market intervention by Japan. Let's have a look at GBP/USD. Readjusting the chart a little bit. Now, GBP/USD remains in a sideways motion. This is the daily chart. We had employment data for April, which tended to send out some mixed signals. However, let's have a look at the market reaction at the release. Drilling to the 1 minute chart, unlocking the chart going down, and here you can see a drop of GBP/USD of around 18 pips, which may not sound as much, but seems to be a marked movement downwards, given that the continuous peaks up until around 10 o'clock, 1 hour after the release, were on the downside, and then it started to move up once again, practically raising the losses made. Readjusting the chart back to the daily chart, and we can see how the price action remains unchanged. So, on the one hand, UK's employment data for April tended to highlight the unexpected rise of the unemployment rate, the tick up. I would be also noting the improvement of the employment change figure, but the improvement failed to meet the market expectations. That's one. The second is that the figure remains deep in the negatives. So these two indicators tend to add pressure on BOE to start cutting rates rather earlier than later. That's the one side. The third element, which I would be highlighting here, is sending a different message. And that's the average earnings. The average earnings accelerated. And I would be adding a little bit beyond market expectations. They're running above the rate of the CPI in the UK, both headline and core. And that tends to imply that the UK employment market is going to continue feeding inflationary pressures within the UK economy, and actually tends to advise BOE to keep rates high for longer. And that's why we're seeing some conflicting messages coming out of the release. For the time being, in the big picture, we expect GBP/USD to remain in a sideways motion between the R1 and the S1. Once again, I would be highlighting USD fundamentals in the Fed's interest rate decision, and should that actually strengthen the USD side of the pair, we may see cable tumbling down below the S1 and starting to aim, if not even reach, the S2 1.2560. On the flip side, should the bulls take over or remain in charge, because if we note here and extend this upward trend line, then we may be discussing that the bullish outlook is being maintained. And in such a case, we would expect the price action to rise, breach the 1.2805, and start aiming for the 1.2890. And I'm highlighting this because for a bullish outlook to be maintained, we would require a higher peak than this one. So the price action has to breach above the R1 for the bulls to remain in charge of the play. On the other hand, though, the real relative stabilization of the pair tends to imply that a sideways motion could prevail here. And definitely the RSI, which has dropped and has neared the reading of 50 and remains at that level, tends to imply that the bullish tendencies within or among market participants have faded away. And more or less, the market remains rather uncertain about the outlook of the pair. While once again, a possible strengthening of the US dollar could also be a factor which could drive GBP USD lower. I would be highlighting from the GBP side of the pair as for financial releases, also the release of UK GDP rate for, I think that's the month of April. It's a bunch of data which are coming out during tomorrow's early European session. And I would expect the data to mostly weigh on the pound unless we're getting some mixed signals once again. The GDP rate is expected to slow down, remain in the positives, but slow down. And that's a big question for the UK economy. So that may weigh on GBP USD as well, but that's tomorrow. Let's have a look at USD CAD. USD CAD remained sideways yesterday, yet today has renewed its bullish tendencies. And this, let me readjust. And it's currently aiming for the R1, 1.3785. The RSI indicator is on the rise. It's at the reading of 60. Let me check. Yep, 60.3. So that tends to imply that the bullish sentiment is slowly building up for the pair, which may drive it even higher. And should the bulls maintain control, I wouldn't be surprised to see the price action breaking the R1, 1.3785, and start aiming for the 1.3895. On the flip side, I have some worries here in the sense that the price action is flirting with the upper Bollinger Band. And that tends to slow down the bulls or even could cause a correction lower for the pair. Let's have a look also at WTI prices, given that WTI tends to be in a positive correlation with the Canadian dollar, as Canada is a major oil producing economy. Here it is. It's the daily chart. Now here you go. We had a rally of oil prices, of WTI prices yesterday, and I have to note here that it's the largest gain for oil prices maybe since the start of the year, within a day. The price action of WTI rose, breached the 76.65 resistance line, which now has to be turned into support line. Let's do that. And let's go hunting for a new ultimate resistance line. Definitely this peak here is quite telling. It's the 87 resistance level. Locking it in, adjusting the chart, coloring it in red, just to be able to distinguish it easily. Let's correct the labels, with the R3 now being set at 87. The R2 at 83.6. The R1 at 80.10. The S1 at 76.65. The S2 at 71.50, a level which was aimed for but not quite reached by WTI's price last week. And finally the S3, which is also the lowest level in our chart right here, would be the 67.90. Let's log everything in. Now let's discuss oil prices. Oil prices seem to have an upward momentum. I know it seems like a correction after the losses made in the week before, but the upward movement of yesterday tended to highlight those bullish tendencies. And at this point, it would be interesting to note the 4-hour chart. You can see how there were upward movement, higher peaks, and note the acceleration of yesterday, reaching a peak right here. Okay, there has been a correction lower, but that's understandable, given that the price action of WTI has breached above the upper Bollinger Band, so a correction was in the cards already. At this point, though, back to the daily chart, I would expect the upward movement to be maintained. Despite a possible correction today, we may see that being renewed in the following days. May I here highlight the fundamentals of the commodities price? And we're talking about the release of OPEC's monthly report. Should the report actually imply that there is a robust oil demand side, that may provide support for oil prices. On the flip side, should the production levels of various OPEC members, which have quotas by the way, be higher than expected, then we may see oil prices falling. May I also mention here that we're getting IEA's report, if I'm correct, tomorrow, which is going to be also of interest for oil traders, where we can draw similar conclusions as OPEC. And as for financial releases, I would be highlighting today AP's weekly crude oil inventories figure. Now, we had an increase of oil inventories last week reported by AP of 4 million plus barrels. Should we see another increase of oil inventories, US oil inventories, that would imply more or less a slack in the US oil market. And let's not forget that the release has to be also verified by EIA tomorrow. So we're going to be having a double whammy over the next 2 days. On the flip side, should we see a tightening US oil market, that could provide a boost to oil prices. So it's going to be a very interesting next couple of days for oil traders, I think. And depending on the outcome, we may see oil prices rising even further. May I remind you guys that there has been lots and lots of speculation about OPEC targeting a price of oil of over $80 per barrel. So that's an issue. Another fundamental issue would be the actual data on the ground of the international oil market. We have seen reports stating that Saudi oil exports to China have been dropping, which tends to imply more or less a weakening demand for oil from the Chinese side. And should such whispers and reports multiply, we may see them having a bearish effect on oil prices. And last but not least, besides the FX market, I would expect the Fed's interest rate decision to have also an impact on oil. Should the Fed actually imply a tight monetary policy for a longer period, we may see oil prices falling. And the reason why I'm stating this is because should the Fed actually maintain a tight monetary policy with high rates for longer, that could weigh on economic activity, especially in the US manufacturing sector, which in turn could more or less imply a weakened oil demand from the US. Okay, let's have a look also on the Aussie against the US dollar. Now, AUD USD seems to be struggling to break below the 0.66 line. You can see it right here, despite a correction higher. Also note the RSI indicator, which dropped below the reading of 50 and actually hit it as a ceiling and corrects lower once again. It's a little bit unconvincing in my opinion, but there seem to be some slight bearish tendencies. And to tell you the truth, the correction higher of yesterday was partially understandable in the sense that the price action briefly breached the lower Bollinger Band, which more or less tended to force it back up once again. I wouldn't be surprised to see the price action dropping and starting to aim for the 0.6515 support line within the next couple of days. For the time being, I tend to expect more or less that we may see some bearish tendencies actually building up for the Aussie, which is very, very sensitive to the market sentiment given its nature also as a commodity currency. We have also financial releases which could affect the Aussie, so be on the watch out for them as well. Okay, let's have a look for gold's price. Now, gold's price maintained a clear negative correlation with the US dollar. And I would be noting that definitely the drop of Friday tends to highlight or reflect the strengthening of the USD after the release of the hotter than expected US employment report for May. I think the big question mark for gold traders in the coming days is going to be the Fed's interest rate decision tomorrow. Should we see a more hawkish than expected Fed, that may more or less allow for the US dollar or push the US dollar higher. And in reaction to that, we may see gold's prices falling, possibly breaking the S1 2277 and starting to aim, if not even breach, the S2 2227. For the time being, there seems to be a relative stabilization, but I would be noting here the head and shoulders formation being in the works. And I'm highlighting because we have, allow me to show this. The one shoulder, the head, and the second shoulder. In that case, if that's the case, then expect a wide drop. And definitely for confirmation, we would require the pair to breach the neckline, which is at the S1. And at that case, I wouldn't be surprised to see the precious metals price tumbling down all the way below the S3 2186. It's an interesting element which has not been verified yet. I have to stress that. And should it be verified, then we would be talking practically about a wide drop lower. Okay, let's have a look at US stock markets, and I would be choosing among the main indexes NASDAQ. Zoom out, it's the daily chart, readjusting it. Sorry. There you go. Now, interestingly enough, I'm going to be shifting the upward trend line right here. I think that's more than obvious. One could extend it backwards a little bit. Lower it. There you go. We have a series of higher peaks and higher troughs supported by an upward trend line. The 20 moving average, which is also the median of the Bollinger Bands, the 50 moving average, the green line right here, and the 100 moving average are all pointing upwards. That tends to highlight more or less an upward movement and the prospect for the upward movement to be maintained. I would be noting here that also the RSI indicator is pretty high. It has not breached the reading of 70, so there is a bullish sentiment present among market participants. So we may see the price action in the following week actually breaching the 119,300 and start aiming for a possible, or if you prefer, we're setting the next possible target for the bulls at 19,900, sorry. On the flip side, should the bears take over, for bearish outlook, I would require the price action to drop, breach the pre-mentioned upward trend line, exactly signaling the interruption of the upward movement. But for a bearish outlook, I would require also the price action to breach the S1 18,500 and start aiming for the S2 17,800. Mind you that the S1 was already tested in the past week and seems to have held its ground. So more or less, that seems to be valid as a support level. As a side note, I would be noting the stock split performed by NVIDIA share price. It's an interesting development in the sense that, okay, definitely an NVIDIA shareholder does not get richer by the stock split as such, because the drop of the shares price is being compensated by more shares. It was a 1 to 10. The main issue on a fundamental basis, though, for NVIDIA share price is that the stock split makes the price far lower, thus more attractive. And that may increase demand given also the AI frenzy dominating the stock markets in the US, especially right now, which could provide additional support for NVIDIA's share price. So that's an issue I would be keeping a close eye on. Other than that, I would also have a look at Dow Jones, which is a little bit more seclusive. And we can see a different picture here, where you have a sideways motion, and at this point it's between the 39,140 and the S1 38,000. The levels were both tested in the past days, so they're pretty valid. The interesting element I would be highlighting practically with this is exactly the fact that the direction of US indexes is not uniform. We have different directions depending on the width of the index. So for example, Nasdaq, we're talking about 100 shares, while Dow Jones is for 30. And if we drill into S&P 500, that's another picture. So overall, we will have to work on a case-by-case basis here. And in my opinion, I would prefer these two, i.e. the 500 and Nasdaq, in the sense that they both have some consistency in the upward movement. So that could push the price action even higher, or at least it's supported by clear upward trend lines. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.